Intuitive Surgical is currently trading at $462.74, showing a gain of about 0.93% for the session. Now, the immediate market expectation when people see that $4.27 move is to attribute it to the simple narrative: they sold more multi-million-dollar Da Vinci robots. But the reality of what supports this $462 price tag and what dictates its daily volatility is far more complex and, frankly, far more durable. This stock doesn't move just because a hospital buys a new machine. It moves based on the data that machine generates, specifically the number of procedures being performed. The real story here isn't the capital sale, it's the high-margin recurring revenue from the disposable instruments and accessories used in every single surgery. That is the engine, and the $2 million robot is just the key to start it. Most investors see the impressive hardware. The ones who understand this company are tracking the utilization rates of the 8,000-plus systems already installed worldwide. Let's establish the common ground. The general belief about Intuitive Surgical is that it's the undisputed monarch of robotic-assisted surgery, RAS. It's seen as a wide-moat, long-term compounder, a foundational holding for any serious healthcare or technology portfolio. People look at it almost like they look at Apple stock for its ecosystem or Nvidia stock for its processing dominance. The expectation is simple. As more surgeries become robotic, Intuitive stock will just keep climbing. This is the story that gets told on various investing sites and is a popular holding for those using self-investing platforms. But this expectation, while directionally correct, dangerously simplifies the current situation and the pressures facing the company right now. The deeper reality is that Intuitive's dominance is facing its first credible set of challenges. This isn't about the technology failing. The Da Vinci system is superb. The challenge is economic and competitive. On the economic front, Intuitive's primary customers, hospitals, are under immense financial pressure. Post-pandemic staffing costs, inflation in medical supplies, and higher interest rates make it much harder for a hospital CFO to sign off on a massive capital expenditure. This creates a bottleneck. So while the surgeons want the new Da Vinci SP, the hospital board might delay the purchase by a quarter or two. This is the short-term friction that the market narrative often ignores. That volatility you see, the sudden drops after an earnings call, it's almost never because the company missed on revenue. It's because their procedure growth guidance for the next quarter was maybe 13% instead of the 15% analysts demanded, a sign that hospital CapEx budgets are tightening. Then there's the competitive reality. For nearly 2 decades, Intuitive had no real competition. Now you have Medtronic with its Hugo system and Johnson & Johnson developing its Ottava platform. While these competitors are years behind in terms of installed base, data, and surgeon training, they are still colossal organizations. Their presence alone begins to change the conversation, especially on pricing. Intuitive could once name its price. Now it has to actively defend its value proposition. This doesn't mean the moat is breached, but it does mean the company has to work harder to maintain its margin profile. This is a level of analysis you might not get from a simple SoFi robo-advisor or basic investment help services. It requires looking at the competitive landscape, something that serious traders using the Interactive Brokers platform for interactive broker stock trading spend a lot of time on. Looking at the stock's recent performance, today's 0.93% move is fairly typical of its behavior. It's a high beta name, but it's also a flight to quality stock within the medtech sector. When the broader market gets choppy, investors often move into companies with highly predictable, recurring revenue streams. Intuitive, with its razor and blade model, is the poster child for this. The trading volume today is moderate, suggesting this isn't a massive institution institutional rotation, but rather a steady drift upward, likely in sympathy with the broader healthcare equipment sector. To truly understand this stock, you have to dissect its last earnings report. The headline numbers, revenue and earnings per share, are just the beginning. The entire market immediately scrolls down to two metrics: Da Vinci procedure growth and new system placements. Procedure growth is the blade revenue. System placements are the razor sales. The market wants to see robust double-digit procedure growth, ideally in the mid-teens. This confirms that existing robots are being used more and that the company's expansion into new areas like general surgery, like hernia repair, and thoracic surgery is succeeding beyond its original foothold in urology and gynecology. If procedure growth is strong, the stock flies. If it's weak, the stock gets punished, regardless of how many new systems they sold. This is why this stock is not a casual trade. It's not something you just buy on the Robinhood app alongside Robinhood crypto positions. This is a core holding. The vast majority of Intuitive stock is held by major institutions. Think Fidelity mutual funds, Fidelity ETFs, or massive pension funds. These are sticky-fingered owners. This means that a lot of retail investors using platforms like SoFi Invest or even Fidelity for their individual brokerage account might find the entry price steep. At over $460 a share, this is where Robinhood fractional shares become a popular tool for online investing, allowing people to invest online with a smaller capital outlay. But the investment thesis remains a long-term one. It's a key holding in many automated intelligent portfolio solutions like Schwab Intelligent Portfolios, precisely because its business model is so strong. Let's briefly touch on what the company actually does, for those who are new to the name. Intuitive Surgical develops, manufactures, and markets the Da Vinci Surgical System. This is a sophisticated platform that uses robotic arms, a 3D high-definition camera, and advanced instrumentation to allow a surgeon sitting at a console to perform complex, minimally invasive surgery. The key benefits are smaller incisions, less blood loss, shorter hospital stays, and quicker recovery times. But the company's genius, as mentioned, is the business model. First, they sell the Da Vinci system, which can cost anywhere from $1 million to over $2.5 million. This is the capital equipment sale. Second, they sell the proprietary endo-wrist instruments and accessories. These are the blades. Each procedure requires a new, sterile set of these instruments, which costs the hospital thousands of dollars per surgery. This generates a massive, high-margin, recurring revenue stream. Third, they sell service and maintenance contracts. These complex robots need to be serviced, and that creates another subscription-like recurring revenue stream. This three-pronged model creates an incredibly sticky ecosystem. Once a hospital buys a Da Vinci and its surgeons spend hundreds of hours training on it, the switching costs to a competitor are astronomical. It's not just about buying a new robot, it's about retraining an entire surgical department. The company isn't still either. Its growth is now coming from two new platforms. The first is the Ion endoluminal system. This is a separate robotic platform designed for minimally invasive lung biopsies. It uses an ultra-thin, maneuverable catheter to navigate deep into the peripheral lung, allowing doctors to detect lung cancer at a much earlier, more treatable stage. This opens up a completely new market for Intuitive. The second is the Da Vinci SP system, single port, which allows surgeons to perform an entire procedure through one single small incision. This is the next step in minimally invasive care. These platforms are often overlooked, but they represent significant future growth avenues that the market is still trying to price correctly. This brings us to the future outlook. The primary catalyst for Intuitive Surgical remains the global adoption of robotic-assisted assisted surgery. In the United States, penetration is high in certain procedures, but still very low in others, especially general surgery, which is a massive market. Internationally, the opportunity is even bigger. Countries in Europe and Asia, particularly China, are just beginning to adopt RAS in a widespread way. As the global middle class grows and demands better healthcare outcomes, the Da Vinci system is a natural beneficiary. The Ion and SP platforms are also key catalysts as they expand the company's addressable market significantly. However, the risks are just as real. The number one risk in the near term remains the hospital capital expenditure environment. If we enter a recession or if interest rates remain high, hospitals will delay purchases of new systems. This won't stop procedure growth as the installed base is still working, but it will hit the system placement numbers that the market watches so closely. The second risk is competition. While Medtronic and J&J are far behind, they don't need to win to hurt Intuitive. They just need to capture a small slice of the market, or more likely,